Time now for Options Corner. Joining us to take a deeper look at Amazon is Rick Duquette, lead market technician. All right, Rick, this one has trailed other members of the Mag 7 this year. What trends do you notice on this chart for Amazon?
Amazon can be kind of a tricky company to compare because it has its hands in so many different areas of the market here. So if we were to think about Amazon versus e-commerce, Alibaba, it's got its other whole thing going on with all these AI chips. So that's the outperformer here. But below eBay and Etsy, but far above Pinduoduo, which is Temu here. So kind of in the middle of the pack toward maybe even the lower end in that regard against conventional big box stores here, Walmart, the only outperformer, but Best Buy and Target really struggling here. But finally now I have to make another third chart. Pretty inconsiderate of Amazon make me do this, but now pharmacy stocks are pretty hard to compare actually, because if you think about it, Walgreens no longer trading here. It's gone private here. Rite Aid essentially worthless. So pretty much all we got is CVS and purple here. Walmart also, once again, has its own pharmacy stuff. But I was also thinking Cardinal and McKesson because these are the distributors of the supplies. One of the things that makes Amazon so difficult is they do horizontal and vertical integration. So those suppliers could actually also suffer with this news. But if we were to look at our chart here, downward sloping channel, our trend line here in blue going upward has been broken here. But we can see that our lows came in near 216, our green line here. If you were to backtrack, this was an important price level previously here based on these lows. So that's the supportive area to watch out for in the shorter term. In the upside area here, we can see that this red line, 226, was a frequent stopping point for price as well. So 216 to 226, 10-point range gives us some boundaries to consider. If we add some other studies here, we can see that we have our RSI study showing momentum is more geared toward the bearish side, but hanging on to that green trend line as well. Now, we can see that our volume profile point of control lines up with our linear regression line and two of our moving averages as well. That comes in right near 224 or so. So this seems like a key area that the bulls would need to hold on to and eventually push above to set their sights higher. Volume also is heavier here near about 230 and about 215. Finally, if we were to overlay our other studies together and also look at our expected move for October 17th, we can see that once again, pretty much everything converges here near about 223, 224. So that's the breakout area here. We start to get beyond our expected move when the volume dries up here near about 233 or so. Then to the downside, similar picture. Volume node is the edge of the expected move near about 213 or so.
Thank you, Rick. Now to take us through an example trade, we're bookending with Tom White, senior options contributor and co-host of Fast Market. So, Tom, how would you approach an example trade for Amazon?
Well, it's severely underperformed the Mag 7 names, the tech space in general. It's about 8% off of those all-time highs. Been consolidating, only up just over 1% so far in 2025. So I looked at a strategy that takes advantage of movement ahead of earnings while avoiding earnings if you have a directional bias on this type of stock where implied volatility levels aren't that elevated at this point. So I went out to the October 24th weekly option series, 16 days to expiration. You're going to avoid the earnings event, which takes place after that expiration the following week. And a pretty straightforward bullish call vertical here. If you think this stock is going to rally into those earnings. Sometimes we'll see some analyst calls come out ahead of earnings. If you think it's going to rise into earnings while avoiding that event, this strategy takes advantage of it. So going out to the October 24th weekly cycle, 16 days to expiration, buy the slightly in the money 222.5 strike call. Stock's going to open up here about 223. So that's slightly in the money. It's got the higher delta. It reacts more like the stock. And then against it, because we want to offset some costs on that bullish call purchase, we're going to sell the 232.5 strike call. So a bullish $10 wide call vertical. You're going to pay roughly about a $4 debit for it. There's your risk, $400 per spread, with max profitability at about $600 on this $10 wide bullish call vertical. So the risk reward setup's pretty good. And if you pay that $4 debit, takes your break even up to $226.50 to the upside. That's only 1.5% above the current share price where Amazon's going to open up today. So a lot of times when you're going into earnings, you want to avoid that earnings event. This is a short-term position where, hey, if we get some calls from analysts that say, hey, this stock has lagged, everything is going well, we've got prime days going on, AWS growth rate starts to accelerate a little bit. This could be that catalyst to take us to the upside. It's limited risk. It's risk defined. You know what your break even is. You know what your downside is going into this. And you only need 1.5% move over the next 2.5 weeks to get above that break even.
All right, good stuff there. Thank you, Tom, for that example trade on Amazon. It's a call vertical is the approach there.